Investing can be intimidating, especially for beginners who don't know where to start. In this video, we'll show you how to start investing even if you're a complete beginner. You'll learn the basics, avoid common mistakes, and set yourself up for financial success. So grab a pen and paper and let's dive in. Starting early is one of the most important things to keep in mind when it comes to investing. The earlier you start, the more time you have to benefit from the power of compounding. Compounding is one of the most powerful concepts in investing. It's essentially earning interest on interest, which means that over time your money grows faster and faster. This is why starting early is so important. The longer you have to let your money compound, the more wealth you can build. For example, if you invest $1,000 today and earn a 10% return, you'll have $1,100 at the end of the year. But if you leave that $1,100 invested and earn another 10% return the following year, you'll have $1,210, an extra $10 in returns just from letting your money sit there. Over time, the power of compounding can turn even small investments into substantial wealth. Investing is a long-term game, and it's important to remember that patience is key. Don't get discouraged if you don't see quick returns on your investments. Instead, focus on the long-term benefits of investing, such as compound interest and the potential for your investments to grow over time. Remember that the stock market will fluctuate, but history has shown that it tends to trend upwards in the long run. Stick to your investment strategy and resist the urge to make impulsive decisions based on short-term fluctuations. With time and patience, your investments can grow and lead to a secure financial future. Setting clear investment goals is crucial to success in investing. You should have a specific idea of what you want to achieve and when you want to achieve it. For example, your goal might be to save for a down payment on a house in 5 years, or to build a retirement nest egg for when you retire in 30 years. When you have a clear goal in mind, you can make investment decisions that align with your objectives. It's important to be specific with your goals, so you can create a plan of action. You should also consider your risk tolerance and investment time horizon when setting your goals. A higher risk tolerance may lead to more aggressive investments, while a shorter investment time horizon may call for more conservative investments. Having clear investment goals will also help you stay focused and motivated. It's easy to get distracted by market fluctuations or the latest investment trends. But if you have a clear goal in mind, you'll be less likely to make impulsive decisions. Your investment goals will vary depending on your life stage, financial situation, and risk tolerance. For example, if you're in your 20s, your investment goal might be to save for retirement. If you're in your 30s, you might be saving for a down payment on a house. Whatever your investment goal is, it's important to be specific and realistic. This will help you determine how much money you need to invest and how long it will take to reach your goal. For example, if you want to save $100,000 for a down payment on a house in 5 years, you'll need to save $20,000 a year. It's also important to prioritize your investment goals. If you have multiple goals, such as saving for retirement and a down payment on a house, you'll need to decide which goal is more important to you and allocate your resources accordingly. This will help you stay focused and avoid spreading your investments too thin. Remember, having clear investment goals will help you stay motivated and make informed investment decisions. Aligning investments with goals is crucial for successful investing. It means that the investment strategy and portfolio should be tailored to match the specific goals that an individual has set. For instance, if the goal is to save for a down payment on a house in the next 5 years, then the investments should focus on more stable assets that have a lower risk. On the other hand, if the goal is to save for retirement, then the investments can be more diversified and riskier, because there is a longer time horizon for the investment to grow. It's essential to review and adjust investments periodically to ensure that they align with the set goals. By aligning investments with goals, investors can increase their chances of achieving their financial objectives. Risk tolerance refers to an individual's willingness to take risks when investing in the stock market. It is important to understand your risk tolerance level, as it can affect your investment decisions. Some investors may be more comfortable with higher risk investments, while others may prefer more conservative investments. Understanding your risk tolerance can help you create an investment portfolio that aligns with your goals and preferences. In general, younger investors can afford to take on more risk as they have more time to recover from potential losses. while older investors may prefer a more conservative approach to avoid jeopardizing their retirement savings. It is crucial to assess your risk tolerance regularly, as your financial situation and goals may change over time. When it comes to investing, there are different types of assets you can invest in, and each comes with its own level of risk. Stocks are considered to be more volatile and carry a higher risk than bonds, which are considered to be more conservative. Real estate investments can also carry varying levels of risk depending on the type of property and location. It's important to understand the different types of investments and their associated risks so that you can make informed decisions when building your investment portfolio. Higher risk investments may offer the potential for higher returns, but they also come with a higher likelihood of losses. On the other hand, lower risk investments may offer more stability and predictability, but may not offer the same potential for high returns. Ultimately, your risk tolerance will depend on your personal circumstances, investment goals, and time horizon. It's important to consider all of these factors when determining which types of investments are right for you. Remember, there is no one-size-fits-all approach to investing, and what works for one person may not work for another. Some people are more risk-averse than others, and may prefer to invest in low-risk investments like bonds and CDs. On the other hand, some people are more comfortable taking on higher levels of risk in pursuit of greater returns, and may invest in stocks, mutual funds, or exchange-traded funds, ETFs. Before you start investing, take the time to assess your own risk tolerance. Consider factors like your age, financial situation, and long-term investment goals. Are you investing for retirement, a down payment on a house, or some other financial goal? How much money are you comfortable losing if your investments don't perform well? These are all important questions to consider when assessing your risk tolerance. It's important to note that risk tolerance is not a fixed characteristic, and it can change over time as your financial situation and investment goals evolve. For example, as you approach retirement, you may want to reduce your exposure to riskier investments in favor of more conservative ones that provide more stability. Overall, understanding your risk tolerance is crucial for making smart investment decisions that align with your financial goals and help you achieve long-term financial success. Diversification is the practice of spreading your investments across different types of assets, industries, and geographic regions to reduce risk. The basic idea is that by investing in a variety of different assets, you can protect yourself from the risk of any single investment performing poorly. One of the key benefits of diversification is that it helps to minimize the risk of loss. This is because a diversified portfolio is less likely to be affected by a single event or market trend. For example, if you have all your investments in one sector, such as technology, and that sector experiences a downturn, your entire portfolio will be affected. However, if you have investments in different sectors, some may still perform well despite the downturn, helping to offset any losses. Another benefit of diversification is that it can improve your returns over the long term. This is because different asset classes tend to perform well at different times, so having a mix of investments can help you capture gains across multiple markets. For example, when stocks are doing poorly, bonds may perform well, and vice versa. One way to diversify investments is to invest in different asset classes, such as stocks, bonds, and real estate. Another way is to invest in different industries or sectors, such as technology, healthcare, and energy. Investors can also diversify by investing in different geographic regions, such as the US, Europe, and Asia. Furthermore, investors can diversify within each asset class by investing in a variety of companies or funds. For example, instead of investing in just one stock, an investor can invest in a mutual fund or exchange-traded fund that holds a basket of stocks. Diversification helps reduce the risk of losses in any one investment, as the performance of different asset classes, industries, and companies are not always correlated. In other words, if one investment performs poorly, it does not necessarily mean that all the other investments will perform poorly as well. By diversifying, investors can spread their risk across a range of investments and potentially achieve a more consistent overall return. It's important to note, however, that diversification does not guarantee a profit or protect against losses. It's still possible to lose money even with a diversified portfolio, and investors should always conduct their due diligence and carefully consider their risk tolerance and investment goals before making any investment decisions. Passive investing refers to a long-term investment strategy where an investor holds a diversified portfolio of securities and minimizes trading activity. In contrast to active investing, where investors try to outperform the market by frequently buying and selling securities, passive investors aim to match the returns of the overall market by investing in low-cost index funds or exchange-traded funds. Passive investing is based on the idea that over the long term, the stock market generally provides positive returns, and attempting to time the market or pick individual stocks is a risky and unreliable strategy. Instead, passive investors focus on maintaining a diversified portfolio that tracks the performance of a broad market index, such as the S&P 500. By investing in a diversified portfolio, investors can reduce their risk and ensure that they capture the returns of the overall market. Passive investing is particularly attractive to beginners because it requires minimal investment knowledge, time, and effort. Instead of conducting in-depth research and analysis, investors can rely on the expertise of professional fund managers who manage the index funds or ETFs. One of the main benefits of passive investing is lower fees, as actively managed funds often charge higher fees to cover the costs of research and management. Additionally, passive investing is less stressful as investors don't have to constantly monitor their investments and make trading decisions. By taking a hands-off approach, investors can also avoid emotional decisions that may lead to poor investment choices. It's important to note that passive investing doesn't guarantee returns or protection against losses, but over the long term, it has been shown to be a successful investment strategy. When it comes to passive investing options, index funds and ETFs are the most common choices. An index fund is a mutual fund that tracks a specific index, such as the S&P 500, and aims to match its performance. ETFs are similar to index funds, but trade like stocks on an exchange, allowing investors to buy and sell shares throughout the trading day. Another option for passive investors is target date funds, which adjust the asset allocation over time to become more conservative as the target date, usually retirement, approaches. Timing the market is widely considered to be a difficult strategy, even for experienced investors. It involves attempting to buy and sell securities based on predictions about future market trends. However, accurately predicting market movements is extremely difficult, if not impossible. Even the most experienced investors and financial professionals struggle to consistently time the market. One of the biggest risks of timing the market is the potential for missed opportunities. Investors who attempt to time the market may find themselves sitting on the sidelines during periods of growth, waiting for the right time to invest. This can result in missed gains and significant losses. Additionally, trying to time the market can lead to increased stress and anxiety, as well as higher trading fees and taxes. Another risk of market timing is emotional decision-making. Investors who try to time the market may be swayed by short-term market fluctuations and make impulsive decisions based on fear or greed. This can lead to poor investment decisions that can negatively impact long-term financial goals. Moreover, market timing can be costly due to trading fees and taxes associated with buying and selling securities. Frequent trading can also increase the risk of making mistakes or being subject to market volatility. Overall, timing the market is a risky strategy that requires a great deal of skill and knowledge, and most investors are better off taking a long-term approach and focusing on fundamentals rather than trying to predict short-term market movements. Investment fees are the charges investors pay to investment firms for managing their investments. There are several types of fees associated with investing, including expense ratios, trading fees, and account fees. Expense ratios are the fees charged by mutual funds or ETFs to cover their management costs. Trading fees are charged every time you buy or sell a security, and account fees are charged by brokers to manage your account. Investment fees can significantly impact investment returns, which is why it's important to understand them. Even seemingly small fees can add up over time and have a significant impact on an investor's portfolio. For example, suppose an investor has a $100,000 portfolio with an annual fee of 1%. In that case, they will pay $1,000 in fees each year, regardless of whether their portfolio performs well or not. Over 10 years, that adds up to $10,000, which is 10% of the original portfolio value. Therefore, it's essential to choose investments with low fees to maximize investment returns. High fees can erode returns and limit an investor's ability to achieve their investment goals. In general, low-cost index funds and exchange-traded funds, ETFs, are good options for investors looking to minimize fees. These investment vehicles typically have lower fees compared to actively managed funds. Keeping investment fees low is one of the easiest ways to boost your investment returns over the long run. So when choosing investments, be sure to keep an eye on the fees associated with each option. Investing can seem intimidating, but educating oneself about investing is essential for making informed decisions. By learning the basics of investing, one can develop the skills and knowledge necessary to evaluate potential investments, understand risks and returns, and make sound investment decisions. Education can also help investors avoid scams, frauds, and other investment pitfalls. Learning about investing doesn't have to be boring or overwhelming. There are plenty of resources out there to help you get started and continue to grow your knowledge. Books, podcasts, and online courses are just a few examples of the many resources available. Some popular options include The Intelligent Investor by Benjamin Graham, The Bogleheads Guide to Investing by Taylor Larimore, The Money Guy Show podcast, and online courses from Udemy and Coursera. The more you educate yourself about investing, the better equipped you'll be to make informed decisions and reach your financial goals. It's important to seek out credible sources of information and to avoid get-rich-quick schemes or overly complex investment strategies. By taking the time to educate themselves about investing, individuals can increase their confidence, reduce their anxiety, and achieve their investment goals. When it comes to investing, it's essential to keep a long-term perspective. Many novice investors often get caught up in short-term market fluctuations, which can cause them to make emotional decisions that may hurt their returns in the long run. Short-term market fluctuations are a common occurrence in investing and can have a significant impact on emotions. For example, when the market experiences a sudden drop, investors may feel panicked and be tempted to sell their investments. Conversely, when the market is doing well, investors may feel overly optimistic and be tempted to buy more investments. However, both of these reactions can be harmful to long-term investment performance. It's important to keep in mind that short-term market fluctuations are often unpredictable, and trying to time the market can be difficult and risky. Instead, it's important to remember that investing is a marathon, not a sprint. Investing is all about time in the market, not timing the market. Over the long term, the stock market has historically trended upward, despite short-term dips and fluctuations. By staying invested for the long haul, you give your investments time to grow and compound, which can result in significant returns over time. Regularly reviewing investments is crucial to ensure that they align with your investment goals and risk tolerance. The market and economic conditions can change quickly, and your investment portfolio needs to be adjusted accordingly. By regularly reviewing your investments, you can identify any changes that need to be made and ensure that you stay on track to meet your investment goals. Reviewing your investments also allows you to monitor the fees associated with your investments and ensure that they remain low. It is also an opportunity to assess whether your diversification strategy is working and make any necessary adjustments. Here are a few examples of when an investor may need to make adjustments to their portfolio. Change in investment goals. If an investor's investment goals change, they may need to make adjustments to their portfolio. For example, if an investor's goal was to save for a down payment on a house, but they have now purchased a house, they may need to reallocate their investments towards a new goal. Change in risk tolerance. If an investor's risk tolerance changes, they may need to adjust their portfolio to reflect their new risk tolerance. For example, if an investor's risk tolerance decreases due to a change in personal circumstances, such as retirement, they may need to move towards less risky investments. Market conditions. In some cases, market conditions may dictate a need to adjust an investment portfolio. For example, if the market experiences a downturn, an investor may need to adjust their portfolio to minimize losses or take advantage of opportunities. Rebalancing. Over time, an investment portfolio may become unbalanced due to market fluctuations. Rebalancing involves selling overperforming assets and investing in underperforming assets to bring the portfolio back to its intended asset allocation. By taking the time to regularly review your investments, you can make informed decisions about how to adjust your portfolio and maximize your returns. In summary, start investing early and regularly to take advantage of the power of compounding. Be patient and don't get discouraged, as investing is a long-term game. Set clear investment goals and align investments with those goals. Assess your risk tolerance before investing. Diversify your investments to reduce risk. Consider passive investing options like index funds and ETFs for lower fees and less stress. Avoid trying to time the market, as it's difficult and risky. Choose investments with low fees to maximize returns. Educate yourself about investing through resources like books, podcasts, and online courses. Stay invested for the long term and regularly review and adjust investments as needed. Remember, investing can be intimidating, but by following these principles and staying committed to your investment goals, you can set yourself up for long-term financial success. All right, folks, that's a wrap on our top 10 tips for successful investing. What action steps are you planning to take based on what you learned today? Please share your thoughts and questions in the comments below. But wait, don't go just yet. If you want to avoid investing in the next Fire Festival, make sure to hit that subscribe button and turn on notifications for more financial education content. Trust me, our videos are more entertaining than a TikTok dance-off. Plus, you don't want to miss out on our exclusive giveaway, where we're giving away a lifetime supply of avocado toast. Just kidding, but we might have some cool stuff for you in the future. So what are you waiting for? Subscribe now, and let's get financially savvy together.